I do think the inflation fears are a little over exaggerated and overdone. I think that's a lot of like a lot of that commentary, I think, is coming from the value investors that want that story to be out there because value stocks would probably perform better in an inflationary environment. At least the one that we've been seeing recently, is the 10-year treasury has basically tripled from about 50 basis points up to 160, 165 basis points. I mean, that move was quite dramatic, which coincided with the sell-off in growth stocks. So, clearly there was some correlation there. It does seem like the 10-year treasury has kind of settled in where it is right now, 160, 170, 160, 165 basis points. When someone like Kathy Wood says that, she thinks inflation right now is transitory or, perhaps that was the Fed's words and she used something else. When you see these CPI and these PPI numbers that look really high, they are year over year numbers. If we all remember the pandemic, the COVID pandemic was last year around this time, at its peak, where you had basically, other than e-commerce and a couple retail stores, everything else was shut down. So you certainly had no inflation out there. I mean, if anything, we probably had some deflation. So the hot numbers that we're seeing now are based off of some very, very artificially low numbers last year. So I don't think the numbers that we see right now are sustainable. You're already seeing a rollover in commodity prices. Lumber, copper, and some others are, they've clearly hit their peak and now they're pulling back. Those inflation numbers are related to housing and used car sales, and those are not sustainable. I mean, I'm personally looking for my first home right now to purchase, and it's ridiculous. I mean, every time I go out and look at a house, there's 30 people waiting to take a tour of the house. My real estate agent says that there's already 20 offers, on the house within 24 hours. It's just insane, but that's not sustainable. As mortgage rates start to move up, I think we're going to see a pullback in housing as well. So I'm not overly concerned with inflation. I think a lot of the inflation is already priced into the stock prices that I'm seeing right now. If you look across the growth stock landscape, a lot of these companies are still 40, 50, 60% off their 52-week highs, which were back in February, March in most cases. 50, 60% pullbacks. I think a big part of that is the inflation being priced in. I also think part of it is that these stocks just got way overheated, and a lot of these SPACs were trading much higher on some very lofty projections by the companies. And I think investors are realizing that a lot of those numbers are not attainable. The companies are not going to hit them. So these stocks have to be repriced accordingly. So I think that was the other, another reason we saw the big pullback. And then I still think the shorts were out there. There's $6 trillion in hedge funds, plenty of other individuals and investors that can short stocks. And a lot of these funds are running long short strategies. So there's a lot of capital out there that's always looking for short opportunities. And I think SPACs and small caps were an easy target as inflation was creeping up. The 10-year was moving higher. The story kind of unfolded perfectly for them. And they came after these growth stocks pretty heavily and made a lot of money. But I think we're starting to see the tide turn now. I think growth is slowly coming back in favor as value probably gets a little overextended.